illusion of liquidity from the silver markets, Jared, in my mind, only rebalances, and I think in this analyst's mind as well, through some sort of a squeeze where the physical price has to go much higher. It's already up 33% this year, outpacing gold basically, but it has to go higher.
For silver to really move, you need to get a big influx of retail buyers buying the product. And again, when you get that, you don't have resistance because there's no stockpiles, no supply. And I don't think we're there yet. I don't think we're seeing it. Yes, there's more interest in silver, but I don't see the kind of thing we saw in 2011. I don't see that kind of mania about silver at the moment.
Silver climbed toward $38.5 per ounce on Monday, extending its 2025 rally amid Fed rate cut expectations, a weaker dollar, and surging investor demand. With a 32% year-to-date gain, outpacing gold's 27%, silver's strength is fueled by tight supply, rising industrial use, and record ETF inflows. Andy Schectman, president of Miles Franklin, warns of deepening stress in the physical market. He notes the one-month lease rate has spiked to 8%, while the LBMA's available float has dropped to just 155 million ounces, less than a day's trading volume, signaling a potential short squeeze. A 250% jump in exchange for physical activity further suggests traders are paying premiums to exit COMEX contracts, fearing they could be trapped in a squeeze. Adding to the pressure, Schectman highlights a 250% surge in exchange for physical transactions, where traders convert futures into physical silver outside the COMEX system. This spike signals that participants are paying premiums to avoid getting caught in short positions, reflecting rising structural stress in the market. What makes the situation more critical is the massive paper volume used to suppress prices. In May 2024 alone, 487 million paper ounces traded in one day to hold silver near $36, followed by 356 million ounces to keep it below $37. Taken together, these trends point to a market under pressure, where physical shortages, aggressive paper suppression, and rising investor demand are pushing the futures and physical markets further apart. Before we dive in, don't forget to like, share, and subscribe. Tap the subscribe button and turn on the notification bell to stay updated with our latest insights and market analysis.
We can start with silver, and I would say that the silver market and to an equal degree, the platinum market, to me, are under great stress at the futures level. And it seems to me prices are disconnecting on the futures from the real physical prices. You have a situation where it seems to me that traders across the globe, whether it be in London or in the United States now, are rushing to secure metal to avoid the risk of physical shortages. And physical shortages at that level are very prevalent right now. We can start with the London Metals Exchange. The London Metals Exchange is a 140-year-old exchange. It's the oldest in the world. And according to an article that just came out by a TD Bank analyst, it's the lowest free float ever. I think the guy's name was Daniel Gali, maybe. And he is an analyst at TD Securities, and he argued that the outflow of silver out of the LBMA because of the tariff arbitrage, which I don't really agree with, because I think that was the cover to reshore all the metals. I think it's much deeper than that. I think someone got into Trump's ear and said, listen, man, if you don't do this, if we don't bring this shit back, it's a big problem. The rest of the world is doing it, and I think he understood that. But what he came out and said is because of that, the inventories of freely available silver, we call that the float, is the lowest level in recorded history since they've ever been keeping records, ever. And so I think the number was 155 million ounces. That's less than a day's worth of trading volume for spot silver in London. And this is a short squeeze in what arguably is the world's most important silver trading hub. At the same time, as a result of that, you have a dramatic spike in the cost of the 1 month lease rate or borrowing silver. It's gotten as high as 8%. This is a level that you never see. So you have to pay 8% to borrow silver to cover a short position, perhaps. And this illusion of liquidity from the silver markets, Jared, in my mind, only rebalances, and I think in this analyst's mind as well, through some sort of a squeeze where the physical price has to go much higher. It's already up 33% this year, outpacing gold basically, but it has to go higher. Take a look at the COMEX. And the commercials 2 days ago had about 80,000 contracts net short. That's over 400 million ounces. And they built this massive short position right around 37.50. So silver was up to 39. They were hemorrhaging. Doesn't surprise me that they're trying to bring it down right now. It's at 37, almost 38, 37.80 or so. They're getting closer to that point where this short position is at. They've knocked it down a bit. The breakout, the setup is explosive, and the ability to hold the price down is insane. If you're selling short over 400 million ounces, think about that. That's 3 times the float on the LBMA and many times the float on COMEX. This is an existential threat. So not only has silver hit its highest mark since September 2011, the banks just set a new record for their largest short position ever. At the same time, the exchange for physical, this is when you would exchange a contract for physical or a physical for contract without going through the settlement process on COMEX, it surged almost 250% in the last couple of days, meaning if you want to do this, you're going to pay through the nose because the traders know that these short positions are very dangerous, could very well be trapped. So this increase signals serious stress in the silver market. That's the truth.
Adrian Day, president of Adrian Day Asset Management, underscores a critical dynamic in the silver market, the absence of significant above-ground stockpiles. Unlike gold, which is held in bulk by central banks that can act as sellers during price surges, silver has no such institutional overhang. This lack of large-scale supply means that when demand rises, whether from investors or industrial users, there is little resistance, allowing prices to move sharply and quickly. This structural characteristic is playing a pivotal role in silver's setup for 2025. While the 2021 short squeeze ultimately failed to break the system, Adrian notes that the current environment is far more precarious. Vaults are thinner, industrial demand continues to grow, and institutional short interest remains elevated. The risk-reward outlook is more asymmetrical than it has been in years. And unlike in 2021, when retail investors on platforms like Reddit attempted to drive the market, this time, the pressure may be building from within the institutional core of the global silver trade. Supporting this outlook, Citi projects silver will rise 5% to reach $40 in the short term and up to $43 over the next 6 to 12 months. Their analysts cite several converging factors: persistent supply deficits over multiple years, reluctant holders who won't sell without higher prices, and strong investment demand. These elements collectively point to tightening availability and upward price pressure. Let's get back to the video.
We all know about silver, but it tends to have these spikes. It tends to move more dramatically over a shorter period of time than does gold, both on the upside and the downside, incidentally. Because A, it's a smaller market, but also because of some of the characteristics of the market. If you look at the supply of silver, something like 78% of silver supply is byproduct. It's a byproduct of other mines. Most of those mines are not gold mines, they're not a precious metal, but some comes from copper, but a lot of them zinc mines, lead mines, tin mines. Well, if you're a Bolivian or let's say you're a Peruvian zinc producer, and 8% of your revenue comes from silver, if the silver price goes up 50%, right, you don't build another zinc mine because the silver price has moved up. And so the point of what I'm getting at, the point of that is that silver supply is not responsive to changes in the price of silver. That's really important. And that's unlike, say, gold. Now, of course, gold doesn't immediately respond, but over a certain period of time, gold will respond as you get companies doing expansion and you get more new projects come on and so on in response to a higher price. There are very, very few pure silver mines in the world, either in production or even in development. And so that's an important point. And the other important point, of course, is that we don't have large above ground stockpiles of silver. So when the silver price moves up, there is no big seller. The Chinese central bank doesn't say, well, let's reduce our silver holdings, because they don't have any silver holdings. And so, when silver starts to move for whatever reason, there tends to be very little resistance to it because of those factors. My own sense is this, and some people won't like me saying this. My own sense with this current move is we've moved to a new floor, probably a $33. When I look at the chart, I don't pretend to be a technician, but $33 or 32.80 looks to be a good support level for gold. And even if that breaks 30, is almost a brick wall.
I'm sorry, you said gold. You meant silver?
Silver,
Silver.
sorry,
Okay.
silver. So we've come to a new floor
Yeah.
in silver. Are we going to run to $100 in the next few weeks or months? I don't think so. And the reason I say that is because for silver to really move, you need to get a big influx of retail buyers buying the product. And again, when you get that, you don't have resistance because there's no stockpiles, no supply. And I don't think we're there yet. I don't think we're seeing it. Yes, there's more interest in silver, but I don't see the kind of thing we saw in 2011. I don't see that kind of mania about silver at the moment.
Silver continues to outperform gold in 2025, driven by tightening supply, strong industrial demand, and mounting signs of market stress. As available stockpiles shrink and investor interest accelerates, silver is showing greater momentum and heightened sensitivity to current market dynamics. While gold remains a reliable store of value, silver's distinct role positions it for potentially sharper gains as demand intensifies and availability further tightens. Despite recent price increases, many analysts still view silver as significantly undervalued. The ongoing gap between futures pricing and physical premiums highlights underlying market distortions that may not fully reflect the true supply-demand balance. Could silver be the top-performing metal of 2025? Share your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Only 4.5% have subscribed, so hit the bell icon and turn on notifications to stay updated. Your support helps us continue delivering the latest market insights to you and the entire community. Thank you for tuning in.